you have a practice or are you running a business? Valuation is the ultimate KPI.
Hey there, welcome to the Valuations Podcast brought to you by Trulytics, the premier transition management and business optimization platform for the wealth management and insurance industries. My name is Mike Langford and I'm the host of the Valuations Podcast. And today I'm flying solo. So thank you for joining me. Usually I do have a guest on this podcast, and maybe it's a little strange for you to hear me flying solo, but it's not strange for me. I've flown solo on many more podcasts than I have had guests. And I thought today was a good opportunity to do a solo podcast because the really interesting topic was teed up by Carla McCabe on the blog over at blog.trulytics.com. And she had this really insightful and detailed post that you've got to go read. It's called Understanding Add Backs and Adjustments. And it's all about when you are considering the valuation for a business that you are either thinking of buying or selling. During the negotiation process, there's going to be things you want to add back into to kind of increase the valuation. And there's going to be some things you'll want to adjust down to reduce the valuation, because when you think about a business, you're buying all the cash flows that come with that business, right? You're buying the long-term valuation of that business and what it means to your existing business. And so there's going to be kind of some tinkering, like this stuff I want to include, and that's kind of going to hurt me or cost me. So I want to remove that from the equation. So really, really great post. You absolutely need to read it. Number one, because, well, first of all, if you're a regular listener to this podcast, chances are, actually, it's highly likely that someday you're going to be involved in either selling a business or buying a business, whether it's an individual book of business, if you're a solo advisor or a solo agent, or if you own a business, you're probably going to sell it someday, or maybe you're going to look to expand and acquire another business, or maybe you just, a staff member and you're going to be involved in either having your business sold or acquired. So really, really interesting stuff. Highly recommend going to check out the blog post. Again, Carla's a certified valuation analyst. I mean, that's a real deal, a CVA, kind of like a CPA or CFP or CFA in the wealth management industry. So it's a legitimate, like really hard designation to get. So she knows her stuff when it comes to valuation. So check it out. While Carla was writing the piece, we had this really interesting discussion. And this is kind of going to tee up where I wanted to go with this topic, where I'm hoping to kind of add some extra color to it. Is we had this interesting discussion back and forth. Carla was looking to find a parallel to maybe make the analysis that she was sharing a little easier to digest from a readability perspective. That, maybe we could have a parallel with restaurants and kind of use that as a way to get people to understand something a little bit better. But in our back and forth, we kind of came to the conclusion that, there really is no parallel, right? There's no parallel to the wealth management business and the insurance business. They're incredibly different from just about any other business in the universe. I mean, think about the wealth management business if you're in an independent broker-dealer situation, right? In that model, it looks nothing like anything else. I mean, think about it. Where else can you find independent business owners who will willingly give up a control over their earnings in some respect and control over the things that they can do from a business operations and from a marketing perspective to a vendor, right? The independent broker-dealer is a vendor to the independent financial advisor who owns their own business. They may be in an LLC or an S Corp or even a C Corp, right? If they're getting big, but they own their own business. And yet the IBD has some control over that business. And, oh, by the way, they get a cut of the money, right? Now, in exchange for that, they offer compliance assistance. They offer trading on their platforms and practice management platform assistance, and all sorts of other goodies come along with that. So it's not like they're just kind of, sticking their hand in their pocket and taking it with no value. But it's a really kind of unique business situation that you don't really see anywhere else. I mean, franchises kind of sound a little like that, but in a franchise model, what you're really paying for is you get the brand, and the brand does all the marketing for it, and they design all the menu and everything for you. They basically dictate everything about the business. and you get to kind of own your location and reap the rewards of everything that the franchise does for you. But in an independent broker dealer model, that doesn't really happen. Most advisors, don't even really use the brand in their marketing of themselves, right? They're marketing them themselves as, Mike Langford Financial type of deal, right? So really, really interesting and unique. And the fact that they're so unique is the reason why it's so important for you to really take time to understand what drives valuation, because it's not like other businesses. And if you've ever been involved or seen another business bought or sold, it doesn't look like this, right? I mean, think about it, right? Most businesses, you may be buying equipment, you may be buying a brand, you may be buying a whole bunch of stuff in there that doesn't really apply here. Frankly, most other businesses do not have the recurring revenue streams that are predictable and will be there whether their business is up or down. Like a wealth management or an insurance business does, right? The money just kind of keeps coming. There will be some variability in it, but if the clients stay, the money stays, the revenue stream stays. So really, really interesting. One thing that Carla outlines in the article is that when the negotiation's happening, the buyer is primarily looking at acquiring a cash flow stream. And so it's only natural that, at Trulytics, we recommend that you use the discounted cash flow methodology to evaluate the cash flow stream that you're going to get. You're not just getting revenue, you're getting after expenses, the kind of, gross margin, if you will, of the business. Now, many people use the EBOC, which is earnings before owner's compensation, to kind of use that as a fair measurement of cash flows. And Carla goes into detail on that. So you could look at that and get a detailed understanding of where she thinks you should go and what she thinks should be added and excluded from the cash flow projections for any given business. What I want to do is chat today a little bit more about what it means to acquire a business that has an office or multiple offices and staff, right? Carla covers that too, but I want to think of it more from a strategic perspective and what it means to your business. Because to me, when I think about acquiring another business, I don't just think about the cash flow. I actually think of that plus, right? You're getting more out of it because look, acquiring cash flow is good. It's awesome, right? Especially if you know it's going to be profitable cash flow to you. But you're acquiring more, right? You're acquiring opportunity, I think, when you go to business. And the reason why I want to focus on the office and businesses with an office and staff is that it's dramatically different than buying another advisor's book of business, where if you're buying somebody else's book of clients, basically what you're buying is the right to the revenue streams generated by those clients on a broker-dealer platform. And should those clients stay, great. But if they leave, yeah, you lost it, right? And there's usually not any expenses or any infrastructure that transfers with it. But when you think about acquiring a business that has a location and people, it gets a little bit different. So let's dive into it. I think I've got 4 areas that really popped in my mind. Number 1 is you're acquiring scaling opportunities. And that kind of feels like a no duh, Mike, type of statement. But when you buy another business with an office and people, that new office and its new location offers you the opportunity to grow the business. It's not just bringing in a chunk of revenue and plop, here we go. The business is now twice the size, as an example. If you bought a business the same size as yours, you've bought geographic diversification in many cases, right? So as an example, I live here in Austin. If I decided to buy a business in Dallas, I've diversified where my business is. So God forbid a natural disaster hits Austin, I still have business in Dallas. If Austin goes through a economic downturn that's kind of localized for some reason, that will have maybe lesser effect on my Dallas business. I can access new types of clients as well, vertical type changes, right? So maybe my business here in Austin is primarily centered on the tech segment for clients. And in Dallas, maybe there's people that are in I don't know, sports entertainment, right? Maybe people who work for the Mavericks and the Cowboys and so forth up there. So there's opportunity to really expand and grow at a scale that's different than it would be should you just continue to grow organically with one office, or you just grab a book of business from an existing advisor, right? You're actually getting a physical location. And so as Carla articulates in her piece, that comes along with leases and salaries and all that type of stuff. And it's really true. But I look at it as from a strategic perspective, this is an opportunity to scale in a new way. Now, secondly, when you think about the people, you've expanded your talent pool. And that's really, really cool. When you acquire a business that has an existing team, you're adding talent wealth, as one of our previous podcast guests, Kelly Cruz, calls it. The talent wealth of your business went up because you've now got new, smart people added to the team. They come with history. They have insights. They have innovative ideas. They also have a client roster, or they've solved problems that maybe some of your existing team have not solved in their past. So by bringing on new people, you expand the kind of the brain power, if you will, the talent of your organization. Now, it comes with some costs, right? There's an integration cost, right? You got to get everybody on the same page. Everybody's going to be kind of thinking the same thing. You've got to transfer them over to your payroll system and all the other things that go along with bringing employees on. There may be some training for cultural fit and integration. You want to make sure that you get people together for company retreats and so forth, to make sure everybody knows each other. And you want to train people from an HR perspective to kind of be on the same playbook, right? So there's a potential cost there. And then, of course, there might be some cultural clashes. Some people may be uncomfortable with change and not like the new people or something like that. So you're going to have to work a little harder to make sure that stuff works. But in the end, that's an investment worth making, because, people, you always hear this, people are your most important asset to a business, because in our business in particular, it is people that make the business run. Your advisors have the relationships with the clients. You need those advisors to keep the clients happy. The person who manages the front desks and answers the phones, that person is the first line of defense in your interaction with clients and with vendors. So you want to make sure that they are working well and maximizing things. So talent wealth, really, really important. You just got more talent wealth. You're expanding that talent pool. So it's something to think about. Yes, cash flow involved, but this kind of a hard to put a number on it value there. Number 3, shared resources. This is one of my favorite. When you would go to business school, and if you ever read about mergers and acquisitions, this is one of the first things they always talk about, is that when you merge two companies, there's the opportunity to find synergies and also efficiencies. And when they say efficiencies, they mean you can reduce costs, right? You can spread costs or thin it out a little bit. So for instance, you don't need 2 chief accounting officers. If you have, taking 2 companies and making them one, you only need 1 chief accounting officer for the company, right? You don't need 2 chief marketing officers. You only need 1 chief marketing officer. So you get some efficiencies there. You also get, frankly, the ability to maybe think about investing in ways that you wouldn't have been able to do, or you wouldn't think made sense economically before you grew the business. So if you had a business that was, maybe doing $1 million in revenue a year, and you expanded it to $2 million in revenue a year, and you grew the team to 20 people with this new merger, suddenly you might feel really comfortable, or more comfortable, spending a few $1,000s a month on digital marketing. Whereas before you're like, oh, that's a lot of money, right? Now you're like, hey, that makes sense for a business our size. We should be investing in digital marketing aggressively to build our brand, to give our team a good footprint, to interact with their prospects, clients, referral partners out in a digital realm where they're spending a lot of their time. So think about that. The shared resources can be a great opportunity for you to make the business much more stable, and then easy to scale down the road. So that's something that oftentimes is, again, at the beginning, you might be able to see some savings, right? So some of those adjustments and add back type stuff, you'll see that some of that activity in there. We're like, hey, I'm going to have some synergies and cost efficiencies. But you going forward, like, I'm not 100% sure exactly how to say this, but I'm going to find some value here, right? And I don't know how that adds up in the bottom line, but you should value it. Number 4, finally, uh, better treatment from vendors. I like this one a lot. You know, and if you've been in the industry long enough, and probably if you're in acquisition mode, you've experienced this. The bigger you get, the better treatment you get from vendors. And that comes in many forms, right? So if you become one of the top producers with your broker dealer relationship, the more scale you have, you get invited to the better conferences, advisor conferences, right? So instead of going to the Marriott, you get invited to the Four Seasons, that type of stuff. You get to go to the really nice shows. Asset managers start treating you really, really nicely. So you kind of get the white glove treatment from all of your vendors. But you also, you start to find some cost efficiencies too. Usually you start getting better deals from people. You start to maybe have an easier time getting through to customer service or getting things pushed through compliance because they want to see you succeed. So that's really, really cool stuff. You also may get access to things like to other vendors that previously you were just too small for. So the one thing that I say is, be careful that don't let it cloud your judgment, right? There's lots of cautionary tales out there of business owners who kind of lose their fastball after they get a little too comfortable, right? Like living the high life. Suddenly it's like, maybe I won't work so hard anymore. But look, it's working hard is what got you to where you are today, and the fact that you're able to expand the business, right? So those are 4 things to really keep in mind from a strategic perspective, and how it may change your business. Now, I've talked about all of those from the buyer's perspective, that these are things that the buyer should be thinking of in terms of value when they're thinking of the valuation of the business they're acquiring and the valuation of the businesses that'll be merged after the acquisition. These things should be in their mind, right? But the same should be true for the seller. If I'm selling my business and we're putting a value on my business, yes, we can value it based on cash flows, and we can add things in and take things out and adjust whatever. But I'm also aware that there are some things that will happen after this merger that this business will become more valuable. So in other words, the future cash flows of this business are likely to be much greater because of this merger than they would have been had these businesses stayed independent. And if I know that, I'm going to be trying to negotiate appropriately in that direction, and you should too. Here at Truelytics, we're all about measuring, quantitatively measuring these things via the Truelytics platform to help you come up with a valuation. But in the end, when you get to the negotiating table, as Carla says, that valuation is a very strong guideline, and it is a standard that you can expect a buyer or a seller who lands at the negotiating table is going to have their Truelytics valuation out and ready to go. And they're going to be showing you how that business compares to other businesses that have comparable size and structure. But keep in mind that these other strategic things are really important as well. Don't push away from the table just because you think, well, that valuation is a little too high for you have to, in your mind, if you're the buyer, think, hey, this is what I'm going to be able to do with this. And it really fits the culture. It's going to allow me to scale geographically the way I want to, go after new types of clients. The shared resources is going to allow me to become more efficient and allow me to be a stronger, more sustainable company. Yeah, this makes sense. And oh, by the way, I really want those people in my organization. They were really smart and great. And that's where I want to go in an organization. Okay. Hopefully you enjoyed this podcast, me flying solo. There will be a few of these sprinkled in. As you might suspect, during the summer, some guests are out vacationing. That kind of wacky concept where people go on vacation and they don't just want to jump on a podcast with Mike Langford. So I wanted to make sure that we didn't let too much time go by without you hearing me. So I'm going to have a couple more of these for you over the next couple of weeks. As always, please do send in your topics and suggestions for people to be on the show. You can reach me at valuations at truelytics.com. Sorry about that. I almost said valuations at mikelangford.com. Don't send it there. Valuations at truelytics.com. You could also swing by the Truelytics website, use the contact form there, or hit us up on the socials. Truelytics pretty much everywhere, or you can hit me up. I'm at Mike Langford everywhere. Love to hear from you. Hope you're enjoying the show. As always, like and subscribe on iTunes, Stitcher, SoundCloud, TuneIn, wherever it is you like to get your podcasting on. And until next week, I hope you have a wonderful day. All right. See ya. Bye.